Through the first half of the year, gold is off to a record start. It's reached 26 new all-time highs, it's surpassed the $3,000 an ounce price level, and it's outperformed most major asset classes, including equities, bonds, and commodities. My name is Taylor Burnette, and I'm here with my colleague, Juan Carlos Artigas, and we're here to talk about gold's performance through the first half of the year and what to expect through the second half. And on that note, JC, would you like to recap what's happened so far?
Hi, Taylor. Indeed, gold has had a stellar performance so far this year. It's up about 26%, as you said, outperforming major asset classes. And behind this is a combination of a weaker dollar, range-bound rates, and just overall a fairly heightened geopolitical risk environment that has boosted investment demand. Now, in addition to that, we continue to see central bank demand, as well as relatively muted recycling that has provided further support to the gold price.
That's great. And given gold's recent performance, we've gotten a lot of commentary and questions around, can gold continue? How long can this trend last? What do you have to say about that?
Well, gold is going to be reacting to primarily four key drivers. Number one, economic expansion and how that links to consumer demand. Number two, risk and uncertainty and the influence that it has on investment demand. The third one is going to be interest rates and the dollar and how that shapes up the opportunity cost for gold. And then finally, momentum that can accelerate or create mean reversions in the price trend. Now, let me summarize or translate that into something more tangible. If economists are correct in their current predictions of GDP, inflation, interest rates, and other key macroeconomic variables, we anticipate that the gold price may remain somewhat range-bound from here, with a potentially upside of about 5% between now and the end of the year.
Now, a lot of economist predictions and consensus expectations serve as a framework and a guideline, and me and you both know that a lot of times these don't necessarily come to fruition, just given the complexity to model these things out. Knowing that, what else are the other factors that could push gold higher from here?
Well, in short, a worsening of economic conditions, whether it is a byproduct of existing policies or other risks that investors are not currently focusing on, but could likely occur given the uncertain economic environment and geopolitical environment. Now, in particular, this may result in a worsening of economic growth, lower interest rates, potential challenges to the US dollar, and altogether boosting investment demand.
And investment demand has been a really interesting area to watch. For instance, if we look at gold-backed ETFs, they're also all off to a hot start to the year. We're seeing flows globally, seeing inflows. And we've already seen 400 tons added through the first 6 months of the year, 500 tons over the last 12 months. And when we look at other periods of prior drawdowns or periods of crisis, we usually see 700 to 1,100 tons being added. So we're still nowhere close to that. That kind of gives us the signal that we're not too saturated and there's some more room to run.
Exactly. And based on that analysis, we would anticipate that flight to quality flows in a worsening of economic conditions environment may push gold prices higher 10 to 15% from here.
Now, we've talked a lot about the base and the bull cases around gold, but what about the other side of the coin? What about the downside? What can push gold lower from here?
It's a little bit of the opposite. Gold's returns so far have been driven in part by trade-related risks. If we were to see a normalization of trade relationships, and we don't mean this in a temporary way, but actually a more permanent resolution, then gold may give some of those gains back. Our analysis would indicate that potentially gold can come down anywhere from 12 to 17% from here. It would still end up in positive territory for the year, maybe single or low digit numbers, but not as high as we have seen so far.
Is there anything else that we haven't touched on today that you think is worth others to know?
Two other things that I want to flag. Number one, new structural demand, especially coming from institutional investors in Asia, that may provide long-term support for gold prices. The second one are central banks. It's important to keep an eye on that. Central banks have been an important contributor to performance over the past couple of years, and we continue to expect central bank to remain robust. However, it may not necessarily reach the record levels we've seen over the past 2 years.
Thanks, JC. Our mid-year outlook, along with all of our valuation tools such as Graham and Quorum, can be found at goldhub.com. Thank you for joining us.